Welcome to TUI Wallet Talks. It's the last few days to the income tax return filing deadline. Many of us find the process of filing income tax returns very daunting, and hence it's important to avoid errors. In this episode, Shalini Jain, tax partner at EY India, takes us through some common mistakes that one should look out for when filing the tax return. So Shalini, what are the common mistakes that I should actually be watching out for when I'm filing my income tax return?
So I think the first step for anybody who's filing the ITR is to ensure that the correct ITR form is filed. And there is a detailed description which is given in the annexures to, or even when you're filing online, there is a detailed guidance given to decide on which ITR form is to be filed. Then once it is determined which ITR form is applicable, one has to ensure that all the heads of income are correctly reported. One common error that we do as individuals is that we forget about certain sources of income. So it is very important for us to collect all the documents. So if we have salary income, please make sure that you have Form 16 from your employer. You've tallied your Form 16 with income that is coming as pre-filled in your ITR form. You should download your Form 26AS from the income tax portal. Form 26AS contains the details of income and the taxes deducted. Make sure that all the sources of income from Form 26A are captured. Then another great check which a lot of people miss out is Form AIS form or TIS form, Annual Information Statement, again which can be downloaded from the income tax portal, gives details of all the income from various sources. One of the common errors for most people is that they forget to report their savings bank account interest. Well, for FD, the bank will give a Form 16A, but savings interest, unless you scrutinize your bank statements, one would not get. So if you download your AIS form, all these different types of income which typically would otherwise get missed out can be captured in your tax return. Then other very common mistake is supposing somebody has changed job during the year. So you have income from two different employers. Now typically what happens is if you don't report the income of the old employer to the new employer, then both the employers end up giving you benefits of standard deduction or the slab rates. And if both the employers have given these two benefits, then when you are filing your consolidated tax return, there is going to be a shortfall which will lead to interest at the time of filing of return. So that's another common mistake that we've seen specifically with respect to salaried individuals. Then with respect to deductions, please make sure that you claim the correct deductions, and you should have valid proof of deductions as a backup in your records. So whether it is deductions with respect to contribution to provident fund, LIC, so all has to tally with the actual contributions made.
So Shalini, it's very important that you get your ITR form right, and most salaried taxpayers actually opt for ITR-1. So who should be filing the ITR-1 Sahaj Form?
Any individual who qualifies as an ordinary resident of India and whose income is up to 50 lakh rupees and has income from sources such as income from salary, income from house property, one house property, agricultural income up to 5,000 rupees, income from other sources such as bank interest, FD interest, post office interest, or family pension, that person is required to file ITR-1. Who is not required to file ITR-1? Some of the examples are somebody who qualifies as a non-resident of India, has income or assets overseas, basically foreign assets, or has income from capital gains, is a director in a company in India or outside of India, holds unlisted equity shares, has more than one house property and income from that house property is taxable in India. So these are the individuals who are not required to file ITR-1, and they need to file other ITR forms.